You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Bob, welcome to the show, and some interesting times on the markets, and interesting if you're interested in Swiss francs.
Yes, this is the big one where the Swiss Central Bank was forced to be accommodative, and it was bothering them, and they stopped, and that jammed the Swiss franc up, I think, instantly 30%, and it settled up 15% on the day. Now, this is, in any language, extraordinary. And it makes me think of back in the early 1930s when Roosevelt, the great experimentator, was fooling around. They had this theory that in the Depression, that if they raised the dollar price of gold, it would put the grains up and help the farmers. So at that time, there was a common market for gold in every country. There were a number of countries on a gold standard. So it was all running reasonably well. And then he started jacking up the price in the U.S. And so and there was some major international monetary conference setting up and that sort of stuff. And it just drove the bankers around the world absolutely mad. And of course it was a form of madness, but what it is, and I'm not all that sophisticated on it, is Switzerland was forced to be extravagant, and then they couldn't stand doing it anymore. But what you've got here is that a number of transactions due and payable in Swiss francs, and a number of people were using the Swiss as the carry, the cheap money to borrow. And all of a sudden, where they were trying to make a 1%, or they're now owing, let's just say 15%. So this is very nasty. And it will, I think, reveal some big traders who are awfully offside. Same as with the crash in crude oil prices. And yeah, of course, last week we noted that the crude thing was kind of overdone, that a probable low was possible in January. Actually, that was a target, a decline at least till January. And so crude oil seems to be stabilizing in here, and but nevertheless, the crash in crude oil is going to leave an awful lot of people offside, and to cover these disasters can be very expensive. So crude may be stabilizing in here for a while. Also, where Ross had the break in copper prices and the target, we came down to pretty close to the target, and also said, hey, the best for the down on this one is in for the moment. So we've got this, and then now it's feeding into a stock rally from a pretty oversold market. But the main thing, Jim, is that these rapid price changes leave behind wreckage that takes a while to come to the surface. So you think back in 1998 with the LTCM disaster. That was long-term capital management. At that time, a very highly regarded hedge fund, doing all of the proper mathematics and stuff, modeling. And essentially, they had bought the story of convergence. That's where all the yields for different instruments in Europe were going to converge on one level. And this assumed that interest rates would trade on the same yield basis in England as in, say, Italy or Spain. So anyways, LTCM was fully positioned and highly leveraged on that one. And then you had the seasonal change in credit spreads. So they were betting that the central bankers could overwhelm seasonal tendencies in the credit markets. And they lost big time. and it required a big bailout. So, but when credit spreads started to change in that June of '98, there was no talk about LTCM until a few weeks later, when suddenly the street started to know that they were all well offside and trying to get covered. And then it turned out to be a disaster. I remember at Citigroup, the big banking stock, fell by 40% by the time the panic completed in October. So we know there's some mystery out there. We know that there's financial pressures. It's just that the names haven't been revealed yet, and they will be revealed. In the meantime, let's say that crude oil does stabilize for a few weeks in here, and the stock market does stabilize and improve a little here, generally. We've done a study that shows that when you've had a crash in crude oil, that it takes months to stabilize. It's not like a V-bottom and straight up, so traders should keep that in mind. And it takes a few months to stabilize, but in that time, the stock market can do poorly. Now, this is sort of generally, so this is something to keep in mind. And the other one that we're looking at here is, with stability in crude oil, you're going to get an interest in low-grade bonds. So the junk bond is, a little firmer the last few days. But the one that we've really been playing is the long Treasury, the bond future. Man, it has been outstanding. We got aboard it in January a year ago and have had a couple of trades out of it, but we're looking for what we've been calling for the last month is ending action. So we're looking for an extremely overbought in the long Treasury, and we thought that would be helped by some weakness in the stock market. So I think the long Treasury can turn around here for a bit. And then on the next weakness in stocks, maybe that be the one where everybody has to own the long Treasury, and it does the technical work needed to make the top. So that's the one we're watching for. But as we advise investors who may not be traders, that there is going to be term risk as this long Treasury gets higher. And we already know that there is credit risk in the market that's being discovered. The credit spreads, as we look at it, the difference between BBB bonds and long Treasuries, with the pressures on on lower grade bonds into the middle of December, that spread got out to 211 basis points. And then things relaxing in the last few weeks here, it came into, was 197 basis points, and now it's at 212. So it's higher than at the worst in December. So that's another alert out there that things in the credit markets are not all that confident. And these changes are irresistible. The best for spreads was accomplished by around June, and then it's been deteriorating since, but it hasn't been a full crisis in the spread market yet. Now, the other one that we watch, and it worked so well for us in 2000 and in 2007, and that was to have the yield curve change, and that's the difference in yield between 3-month Treasury bills or 2-year notes on the Treasuries out to the longer term. And typically in a boom, and we have been in a boom, that yield curve will flatten where short rates rise relative to long. And it has been doing that, but on previous bubbles, it can run 12 to 16 months against the curve being flattened, and sometimes even when a big boom like 2007, it did invert. Also, it inverted in 2000, but with so much screwing around by central banks in the credit markets, this may not go to inversion. But nonetheless, we're now at 12 months, that would be December, of a flattening curve. And we're into the window, like 12 to 16 months, where this could reverse. And last week, the curve really did, on the chart, get up and get quite overbought. So it's had a setback, and then we'll just see how it tests and whether it rolls over. So, but in the credit markets, you want to be aware of two things: the spreads, which is already in an adverse trend, and the yield curve, which has been in a good trend and probably trying to change it now. So
we'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Our favorite listener, Bert Wenkenbach in the Netherlands, has a question for you, Bob.
Yeah.
He says, will the U.S. markets be fueled by the flight of capital from Japan and Europe?
Well, yeah, this has been going on because in the summer months we thought that as the credit spreads widened, it would be indicating a little distress coming in the markets, and that would be accompanied by a rising dollar, which happened. Then towards the end of August and whatnot, the dollar was stronger and the currency was so weak in Europe that, the guys were saying, let's buy U.S. stocks. So they were buying, the big U.S. stocks because there's better liquidity there. And then you had the dollar strong and the stock market strong at the same time. So I think that one's already in the market, that they have been playing the game. But the other one of that kind of flow is that, just to remind ourselves, that a lot of people were trading the Swiss and as a source of the carry trade, and that now is hitting them hard.
Thanks a lot, Bob, for being our guest. My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@HoweStreet.com. I'm Jim Goddard.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.